Welcome back, investors. Thanks for joining in. Today we'll be looking at LVMH, the largest luxury company in the world. CEO of LVMH, Bernard Arnault, has been able to turn the company into what it is today by performing some of the highest quality acquisitions that I've personally seen. Since 1989, they have added a lot of brands to their portfolio. A lot of them you will be able to spot in your everyday life. These are some of the most well-known and high-class brands in the world of luxury, which has been very profitable for the CEO as well. Bernard Arnault currently has a massive 48.5% stake in LVMH, making him the third richest person on earth after Elon Musk and Jeff Bezos, which recently took over his number 1 and 2 position. Currently, LVMH makes up 13% of my personal portfolio as well, making it a large holding of mine. To see how LVMH has turned into this luxury empire, we will head over to our stock insight tool to get an overview of the fundamentals of this company. The metrics that we get presented already make me happy as a shareholder. Growth has not been an issue for LVMH in the last decade, maintaining solid revenue and net income growth. Free cash flow saw its peak in 2021 when most countries opened again and people started buying goods in big numbers. This year was amazing for LVMH, which is reflected in the operating cash flow as well. The debt position of LVMH spiked in 2020 significantly with the acquisition of Tiffany & Co., which, as we can see currently in today's numbers, was a highly successful acquisition. They have managed to reduce their leverage in the years following this though, which is a solid trend. One thing I like about this company as well is their ROIC, which has been above 15% almost every year. And this with a stable profit margin shows the quality of LVMH. We'll be looking closer at some of these metrics in the next segment of today's video. Here we'll be zooming into ratios and metrics to see if LVMH fits our preferences when valuing a stock. We'll be performing our valuation in 3 steps. First is the margin of safety. In this segment, we'll be assessing LVMH's key metrics and ratios to determine if we should be more or less cautious when determining our fair value. In the second step, we'll be performing various valuation models to see what the intrinsic value is of the company based on different metrics. And lastly, we'll combine the 2 steps to give us our fair value of the company. To determine our final valuation, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the financial health, and the growth of the company. I will be using a standard margin of safety of 30%, that can never go below 0%. The margin of safety can either increase or decrease based on the ratios that we'll be looking at in just a moment, and the severity that we'll be increasing our margin of safety with, or decreasing our margin of safety with, is determined by using a scale. When we are using 4 colors scale, bright red will mean a 5% increase, orange will mean no change, light green mean a 5% deduction, and bright green mean a 10% deduction. When we're using 3 colors, bright red mean a 5% increase, orange will mean no change, and bright green mean a 5% deduction. The first metrics that we'll be looking at are focused on growth, and here we'll be looking at the earnings per share growth and the free cash flow per share growth. As we can see, the earnings per share growth has been really solid for LVMH, only seeing a downturn in 2020 for a reason that we probably know all too well. They have grown their free cash flow going from €6.63 a share in 2015 to over €25 a share in 2023. To determine our growth rate, we'll be only using the past 5 years though, which is, in these years, an average growth rate of just over 26%. This falls in the bright green part of a scale, indicating a 10% deduction in the margin of safety. Looking at the free cash flow per share growth, it saw its peak in 2021, which we saw in our stock insight tool earlier. They've managed to grow their free cash flow going from €7.29 a share in 2015 to over €21 in 2023. And in the last 5 years, the average growth rate in their free cash flow per share is almost 21%, which falls once again in the bright green part of a scale, indicating yet another 10% deduction in a margin of safety. Heading over to our next segment, we have the financial health, where we'll be looking at the debt to EBITDA and Altman Z-score. Debt to EBITDA is calculated by taking the debt of the company, subtracting the cash from it, and dividing it by the EBITDA. This gives us the amount of years of EBITDA it takes for the company to pay back all of their debt. And for LVMH, we can see that this is just under 100%, indicating that it takes just a bit less than 1 year to repay all of their debt using their EBITDA. This falls under the 150% to qualify for a margin of safety deduction, so this deducts 5% from a margin of safety. Next up, we have the Altman Z-score. The Altman Z-score is a ratio used to predict whether a company is likely to go bankrupt or not. It is formed by using a bunch of different metrics like working capital, total assets, market cap, and sales. When a company scores lower than 1.8, it has a high chance of going bankrupt, while a score of over 3 means that it's very safe. LVMH scores 8.5 in this, which means that they're very safe. And we see scores like this with a lot of companies that are considered very high quality companies. So yeah, we don't have to worry at all about the financial health of LVMH. And the next segment is focused on us, the shareholders. What is LVMH doing to reward us for owning the stock? Here we'll be looking at the dividend growth and the share buybacks or dilution. As we can see, the dividends have grown significantly over the years. They went from €3.55 in 2015 to €13 in 2023. This is a dividend growth rate in the last 10 years on average of 19%, which is very high. That's something I really like to see. And this falls in the bright green part of a scale, indicating a 10% deduction in the margin of safety. In case of share buybacks or dilution, we haven't seen too much action, although maybe in the chart it looks like it. This is only a minor reduction in share count. It has gone from 505 million shares in 2015 to 500 million shares in 2023. This is only a share reduction of, well, not even a percentage, which means it's an orange part of a scale, no change in the margin of safety on this metric, but it's a good trend nonetheless. And lastly, we have the capital allocation metrics, where we'll be looking at their return on equity and the return on invested capital. Return on equity is calculated by taking the net profit and dividing it by the equity. For LVMH, this ratio stands at 23%, which is in the bright green part of a scale, showing very good quality in this area. This is a 5% deduction in a margin of safety. Next up, we have the return on invested capital, where we will be taking the EBIT, tax rate, and the invested capital to determine this ratio. This ratio gives us an idea how effective the management is at allocating the capital. For LVMH, this ratio currently stands at 14%, which is above the 12% that we really like to see. This is yet another 5% deduction in a margin of safety. And as you can see, most of the metrics that we have determined fit very well into what LVMH shows as quality business. This is why I personally own the stock as well. All of these metrics really satisfy me as a shareholder. So yeah, let's go look at the valuation model next to determine the intrinsic value of the company. The first valuation model that we'll be using is the discounted dividend model. Here we'll be looking at the past dividend payments and projecting them into the future. The average growth rate in the dividends has been sitting at just under 19%. And in our base case for the future, I've determined a 10% short-term growth rate in dividends and a long-term growth rate of 9.5%. And we'll be using a 9% weighted average cost of capital. Taking off the present value of these dividends and adding them all together, we get a sum of €1,064. And with the current share price of €850, this is an upside of just over 23% out of this model. The second model that we'll be using is the multiple valuation. Here we'll be looking at similar companies to LVMH and look at their stock price and their earnings per share. This way we can determine the average PE multiple in the industry, which in this case is sitting at 31.65. All that's left to do for us then, to get our intrinsic value out of this model, is to multiply it by the earnings per share that LVMH is generating, which is €30.35 a share. This gives us an intrinsic value of €961, and once again with the current stock price of €850, this is an upside of 13% out of this model. And lastly, we have the mean reversion theory, and in this model we go by the theory that a company will always trade above or below its mean. And the metrics that we use to determine this are the dividend yield and the PE ratio. In this case, for example, we've taken the dividend yield of the past 5 years, and on average this yield has been sitting at 1.39%, while the current yield is sitting at 1.53%, indicating that's undervalued on this metric. Doing the same with the PE ratio, on average it has been sitting at 33.09, while the current PE ratio is sitting at just over 28, indicating that once again it's undervalued on this metric as well. This is a deviation from the mean of 12%, determining our intrinsic value of €955. And this is the same value delta as the mean deviation. Now that we've gone through all of our valuation models, let's go look at the final overview of our valuation next. Looking at our final overview, we've imported the discounted dividend, multiple valuation, and the mean reversion theory price per share, giving us an average of €987. A margin of safety we've determined earlier, using a standard margin of safety of 30%, deducting it by 10% for the earnings per share growth, free cash flow per share growth, and the dividend growth, and deducting it by 5% for the debt to EBITDA, Altman Z-score, return on equity, and return on invested capital. It pretty much checks the boxes on every single metric that we checked, so that's why we get a margin of safety of 0%. If we apply this, of course, 0% margin of safety, we get the same intrinsic value as the average out of our models. And with the current price of 850 euros, this is an upside of 16%. But let's say that you as an investor have different metrics that you like and you don't want to use this method of determining a margin of safety. That is completely up to you, of course. If we, for example, would add a 20% margin of safety, we would get a downside of 3%. So it would be overvalued if you wanted to add, for example, a 20% margin of safety. But if we just take our own margin of safety, I think it's still an upside. If there's any other companies that you would like to see me cover on this channel, please let me know in the comments. And if you want to get access to our stock insight tool and all of our valuation models, you can check in the description for our Pager link. And thank you for watching and hope to see you next time.